This is Chris Princess with Brook Hollow. And I understand that many of you gentlemen and possibly some of you ladies we're pulling you away from keeping an eye on your brackets. So we promise to have a good show for you. So anyways, we're pretty excited about what we have for you today. We'll keep it to 2 hours. And I am confident you're going to walk away with a lot of new information for some of you folks, well, for both of you folks that we've worked with pretty much on a weekly basis here, and some of the folks that we haven't worked with yet. So with that said, a few admin items here. Most of you should have a audio pin that was sent, and feel free to type that in. That'll allow you to speak to us at any time, and we encourage you to stop us if you have questions. We just ask, if you're not speaking, please do have your phone on mute. You can also send us through your control panel a question if you wanted to type that in, and we will keep you nameless and go ahead and repeat the question and answer that on the phone so we can get all the information out to everyone. So with that said, let us begin. Structured Sales 101. You know, as I have been out on the tour with many of you, what comes to, a lot of folks ask us, you know, what's kind of behind the scene. A lot of people compare me to the quarterback, and well, let's make this more seasonal sensitive. A lot of folks look at me as the point guard on our process here when working with IPX, and that's I'm a very small part of the overall team. And a lot of you have been involved with some of the other folks here that you see on the screen. But for those of you that have, and for those of you that haven't, I just wanted to run through really the team that's on the floor here for you, because it goes well beyond me, and there's really a lot of talent there. And just real briefly, we wanted to make sure everyone understands who's out there working with you and with me to bring this strategy to the client. A number of you have met BJ. He's one of two principals in the company and is the president of the Brook Hollow side. He actually has a background in econ, and of course is very happy today. He comes from U of I, happy that his team is in the dance. Dan McCarthy, who a few of you have met, he's the other principal, and he's the president of the structured settlement side of our business. But he actually, well-educated, he got his undergrad at Notre Dame, got his law degree at DePaul, and his MBA at Northwestern. So very actually intelligent person for those of you that have met him, and has spent a number of years on the structured settlement side and very much knows what we're doing. And again, a number of you have already met him and seen him in action. He's excellent with clients and with working with clients' attorneys. And then there's me, yours truly. I won't spend a lot of time on that. Did my graduate work at DePaul, and as a number of you know, I've been in the 1031 exchange area for a number of years. Brian Michaels, who's our general counsel, has his BA in accounting and, of course, his law degree. Spent a number of years at PwC and at Deloitte, so very heavy in the tax background. And he gets very embarrassed when I turn on this one, but he's done the second and the third structured deals ever with Allstate. So we're very proud, of course, to have him. And, of course, now that we have a number more, there's quite a bit more. So very proud of my colleague, Brian, as well as Joe Papel, who is our CFO and did his undergrad and graduate work at Notre Dame and has over 15 years of real estate background, was with PwC. So again, very proud to have him as a colleague, and a number of you have seen him in action. Excellent, and we're going to be hearing from him later. And Matt Ziwak, who's our behind-the-scenes guy, was director of operations for Bank of America for a number of years, and really keeps no numbers and no documents go out without his watchful eye going through them, and he really keeps things going smoothly and making sure that what goes out is correct. So we wanted to make sure those folks that haven't had a chance to work with the entire team knows what is actually, you know, again, as I mentioned, on the floor in the game, other than just working directly with me. So there's a lot of resources there that you can and should be taking full advantage of. So anyways, with that said, moving right along. And again, I don't be I see a lot of folks on here that we have the pleasure of talking to every week. And then there's a lot of folks on here that we have not been able to work with yet, so we want to make sure we're all on the same page. And again, a little blurb here that a lot of you are familiar with on my signature, and it really just gives a little summation of what we're about and what we're accomplishing here in the market. Today's agenda, what are we going to be covering here? And a lot of this is going to be, you're going to be hearing from Brian a majority of the time, as well as Joe. We're going to start getting into some details here. Not only the tax code 453, but then, of course, the next step was our strategy we're together, which is the structured sale. A little bit on capital gains, just to make sure we're all on the same page and to make sure we're tying everything together. The base installment sale, which is code 453. As I do my travels, each region has a different name for it. The bottom line, it's IRC 453, but sometimes known as installment sale, sometimes known as seller financing, sometimes known as notary back, but all the same thing. And again, structured sale, the nuts and bolts of it. And then, of course, our claim to fame, which all of you hopefully should be very familiar with. Going to cover exactly how this ties in with the fallback, and I think a number of you will find this very informative, specifically on the legal side. Joe's going to go into a pretty detailed review on a case analysis. This is actually an IPX client that we had worked with. We're going to go through the process, how we get the information that we need to help with the consult, and then the client deliverable, what we actually have been delivering to your client. Joe's going to walk through detail in that, so you know exactly what the clients are seeing when we bring them either a traditional structured sale or the fallback. And then something a number of you have already started to use, 3 client ideas, which, you know, as we continue to grow our business and grow our strategies, these 3 have really come out and are allowing you to go into the field for, of course, more education to your channel, but really solutions for clients where previously we have not even been bringing this to the table. And a lot of these ideas have come from a number of the folks here on the call. So as we build our relationship and continue our partnership, these will continue to grow. Okay, with that said, I am actually going to go ahead and, oh, I'm sorry, nope, that's still with me. You know, just kind of as a softball pitch here. You know, let's get this, let's set the mood here. What's wrong with receiving a large lump sum of cash? And everyone here on the phone pretty much would understand that there's really not a lot, but we all wouldn't be, I guess, employed, for lack of a better term, of course, with the consequences of taking a large sum of cash, which, of course, is the distinguished Mr. Uncle Sam. So what, you know, and again, just setting this up, the opportunity for a taxpayer that's selling a property, and God love the folks that still have this problem with the capital gain, what are the options for a taxpayer? Well, number one here, and of course this is everyone on the phone, the main business, of course, is a 1031 exchange, which will always be, of course, the primary business. But again, as a lot of the folks here on the phone have known, what if the taxpayer can't exchange? What if it's a non-exchangeable asset? And we've worked with a lot of you on these exact situations. Of course, a primary residence over the 121 exemptions of $250 if you're single, or $500,000, of course, if you're married, living in the property 2 out of the last 5 years. Vacation properties, where if it doesn't fit into the exchange rules, where they don't get exchange relief or they don't get 121 exemption relief. This is a structured sale has been an option for them. We've been seeing a lot of this, especially with you folks that are working with your business brokers or working with clients that are selling a business where there's really involved. Of course, they can exchange that. But what about the goodwill portion, the profits of the sale of that business, which from penny one are 100% capital gain? And then, of course, our claim to fame, these 2 points here. What if the exchange should fail for whatever reason, either in full or a partial failure where there's equity boot? And again, that's of course where we have come into play with our partnership. Understanding that exchanges are of course the core business, and for the most part clients That's going to be their primary objective, is to have that exchange be successful. And again, just making sure we're on the same page with our partnership, enhancing your core business, which a lot of you have been using to do this where the taxpayer can't exchange. And I know a number of you are finding that when you bring this to your clients, they appreciate at least the opportunity to exhaust this option to see if it would make sense. And again, failed exchanges and other related opportunities, as mentioned here. And something, without naming names, as most of you know, one of your esteemed colleagues had actually found and continues to find different strategies, but a busted installment sale, which out of the San Francisco office we've worked with one of your clients to find that solution, and these continue to be a low-hanging fruit for us. So, anyways, a number of areas beyond the fallback where we have been working with you and your colleagues on bringing the structured sale as a strategy to your clients. Again, of course, as mentioned here, what are the benefits to your clients? Of course, the option to do this where there wasn't a previous option. Again, if nothing else, they appreciate the opportunity to exhaust their options. And a lot of you folks have been using this as a marketing and sales tool to get into offices, either where you are a continued guest speaker. This is something new to bring to them, and a lot of you have included me in those presentations, and we, of course, encourage that to continue going forward. Or new offices to bring this as a competitive advantage. And for IPX, which is you, of course, helping your clients. And again, those of you folks that have been working with us on an ongoing basis see that the clients truly just appreciate you bringing this option to them. Competitive advantage, where a number of you, again, without naming names, but a number of you have used it to quote-unquote steal away from the competitor, just to open a file, letting clients know that this option is available to them because of the relationship that we have. The additional revenue, of course, the structured sale commission and the fallback. And something that we actually, this was created from our relationship with IPX, is what we've been calling the value report. A number of you see this and work with this, but this has led to a number of additional bottom line exchanges, open files, and what we call the 135 plus, which is a lot of clients when they get to their 45th day will remain in the exchange with you to give themselves the opportunity not only to look at possibly closing whatever their IDs may be, but also to give us a chance to present to them a strategy that might make sense. So there's been a lot of business IPX has retained from our partnership, keeping clients from the 45 to the 180th day. Moving merrily along, I am now going to turn it over to Brian, who's going to be going through some of the processes that we've worked with, and as well as getting into some of the legal justifications of the fallback. So with no further ado, Mr. Brian Michaels.
Good afternoon. I'm going to get started here. Thank you. Well, how do you work with us here at Brook Hollow? It's a pretty straightforward process, as a lot of you know. But basically, you ID an opportunity in your client where this might be an option. And really, if you have a question about a client, or you think that somebody might be able to use this, just give Chris a call. Contact Chris. That's the first step, and he'll walk through with you, qualifying the client, making sure the referral gets here, the questionnaire. We work through a kind of a formalized process with a questionnaire of getting some information. Joe does a case analysis, a really in-depth that you'll see in a little while here. And, we make a presentation to the client to give them a really a lot of knowledge and information to make an informed decision about whether or not this is something that would be beneficial for their unique set of circumstances. And then, of course, we close the transaction where it's appropriate. So I'm going to launch into the capital gain review, and And I'm going to talk about the installment sale rules under Code Section 453, because those two are really kind of the core, the basis of getting into the whole structured sale and how it works and why it works. And I'll go through the nuts and bolts of that, which then rolls into the whole 1031 fallback, because it's kind of the foundation of the fallback. And I'll hand it over to Joe, and he's going to go through an actual case analysis. So, and I know this is going to be a little bit basic for some people, maybe not for others, but you know, we all need to be on the same footing. And so let's start with really what's a taxable gain. And I have my cylinder of gold here, I guess is what it is, where you have a total sales price. You're selling something for an amount, and that sales price is made up of a couple parts. Your cost, or basis. A lot of times you'll hear tax people throwing around the word basis, which just really kind of means the tax cost, what you paid for it, or what the depreciated cost is. Anyhow, for tax purposes, it's kind of the cost. And then the other portion represents the gain on the sale. Hopefully it's a gain, or you know, it could be a loss too. But for our purposes here, we're talking about gain. So you have those two pieces, cost and the gain, and it's really just an arithmetic. You know, it's a calculation. So also, capital gains, you really have to characterize the gain in a couple of different ways, and that is the gain ordinary or capital? And then is the gain short-term or long-term? And why is that important? Ordinary gains don't get capital gains treatment. Capital gains, there are capital gains tax rates that are really preferential to ordinary tax rates. So an ordinary gain, for instance, would be the sale of inventory, which if you sell inventory and you have a gain, you pay tax at whatever your ordinary income tax rate is. If you had investment real estate, it's a capital asset, and you get the capital gains tax rate treatment, which are less than the ordinary rates. Then you also have to take a look at, is the gain short-term or long-term? The cutoff's a year. Even if you have a capital gain and it's short-term for less than a year, you pay tax at ordinary rates. That's one of the benefits of an exchange, as you know. You can go into an exchange with a short-term gain and really turn it into a long-term gain. But for our purposes, what we're talking about here today, a short-term gain would be taxed at ordinary rates, and then anything a year or longer of a holding period for that asset, that capital asset, qualifies for long-term gain treatment. So what we need is a capital asset, and it needs to be held long-term for a year or longer. And capital assets are this: stock, investment real estate, bonds, mutual funds, partnership of interest, collectibles, things along those lines. And why is so the rates then, if we have a capital asset that's held for a year or longer and it qualifies for capital gains treatment, it gets these kind of preferential rates. But I'm going to go through what the actual capital gains rates are, and there are three of them. And a lot of people discount this or don't really take this rate into consideration, but there's actually a 25% capital gains rate. And that rate's applied to real property that was subject to depreciation, and it applies to the portion of the gain that represents the depreciation that was already taken. So let's assume that you sell something for 100, you had a basis of 50, and it was it had a basis of 100. You sold it for 100, and you depreciated it by 50. That whole 50 gain would be taxed at 25%. That's kind of a short example of it. But so it's funny how there's a 25% capital gains rate that applies to the portion of the gain that represents the depreciation that you've already taken. Now, one thing to keep in mind about this is oftentimes we'll hear that, well, you can't use installments, which we're going to get into in a minute, but you can't use installment method or installment treatment with depreciation recapture that is taxed at ordinary income rates. Absolutely correct. But you have to, and this is a very, very a distinction that really has to be made is that this 25% rate, or the depreciation that was already taken, is not recaptured depreciation. A lot of people will call it that, but that's not really what it is. Recaptured depreciation is this last point down here. It's accelerated depreciation in excess of straight-line depreciation. That's taxed as ordinary income, and it has to be recognized in the year of sale. So if somebody says, but we have a lot of depreciation recapture in this deal, so you can't use the structured sale or the fallback because you have to recognize in the year of sale, you really need to ferret out whether or not it's depreciation recapture, which frankly I don't see much of, or if they're talking about this depreciate, just the depreciation. Yeah. So just to clarify, that's one of the things of when you give Chris a call, or they bring I get brought in and Joe gets brought in, that we can really clarify that point with clients, and we often do. The next rate, and this is the rate that most people are familiar with, is the 15% rate. That's the long-term capital gains rate, and it's the top rate that's applied to capital gains, 15%. It's effective through next year, through the end of 2010, and it applies to taxpayers, so you can see right there, whose taxable income exceeds $5,100 if they're married. And then in 2011, it's scheduled to spring back to 20%. Although we know that, they're bandied about are different numbers. So, but this is the way the law works right now. In red there, you see I have AGI of 90,000 for a married filing joint with 2 children, and why that's important is, you can really get creative with the right situations, and we see this with people who have, retirement income or income that they can trigger, not trigger, and they're selling an asset, and they have a gain. You can actually fit in. I'm going to go to the next slide here. There's a 0% capital gains rate, and that's effective through calendar year 2010, so through next year, right? And this applies to taxpayers in a marginal bracket of 15% or lower. And you see they're married with taxable income that's not greater than $65,100. But it's an AGI, adjusted gross income, of $90,000. So if you have the right deal this year where somebody has taken, can control what their income is, and we've seen these already this year, you could fashion the payments to not pay tax on $180,000 worth of income. And then depending upon, I'm getting a little bit ahead of myself here, but depending upon what their gross profit percentage in that is, it's possible to maybe even have those dollar amounts be significantly higher than that. But that's just the actual taxable portion, the adjusted gross income portion. So don't discount that 0% rate. Again, we can clarify with people, and this is one of the things that Chris and Joe and I really ferret out and discover with people. And this is a neat little opportunity and trick this year. So this slide is just a table that shows what the rates are. So the top rate is 15%, unless it's 25 there. So the actual rate could be, and probably will be, greater than 15%. And Joe's case study, he's going to go over these kind of next slides that I'm going over, because this is one of the things that we look at. But what we often hear that, well, it's the rate's only 15%, but it's almost always going to be more than that, because you have the 25% rate that we talked about. There's alternative minimum tax that often these it gets triggered because of these sales. You have the phase out of personal exemption, phase out of itemized deductions, and of course the state tax. So the real rate could be upwards of 30%. I'm going to modify that a little bit. It can be even higher than that. So when your client says, hey, you know, I'm not really concerned about capital gains. Yeah, it's going to fail, but it's only 15%. I'm just going to pay it. We actually work through the transaction with them, and you know, does the deferral make sense? And just as a shorthand here, you know, if you had a transaction, a failure, where there was a lot of depreciation that had been taken, and let's say it was in a high state tax jurisdiction like California, for instance, well, right there I'm just adding 25%, roughly 9%. You know, you're talking about a 34% rate without any of the phase-outs or alternative minimum tax. And again, Joe's going to go into that in much more detail in a little while. So now we're going to talk about installment sales. That's kind of the kind of a quick primer on capital gains and capital gains rates. But an installment sale, when we talk about it, really is, maybe we shouldn't say installment sale, but it's actually the installment method. It's paying less tax because you can spread the tax hit instead of in 1 year over a number of years, and possibly into when you have a lower tax bracket, and you're deferring the tax, as you're well aware of with the exchanges, and earning money on the money that you would have spent on tax. But installment method is Code Section 453, and I'm trying very hard to not talk a lot of code sections, but it's very, Chris is laughing because it's very hard for me. But this is what it is. It's a disposition of property where at least one payment is received in the tax year after the year of sale, and then income from an installment sale is taxed under the installment method. And the gain from this multi-year sale, it actually transforms a sale into kind of a multi-year sale, and you pay tax. The gain's recognized over the years when you receive payments. So if you don't get money, you don't pay tax. You get money in a year, you pay tax. And how is that done? And this again is a little bit formulaic, but this really is very simple. This is the way it's calculated: is you have the gross profit, you divide it by the contract price, and that's a gross profit ratio. All that's saying is that if you have $1 that you sold something for, and you have gain in that of 50 cents, so it's going to be 50 cents over $1. 50% is going to equal gross profit. So of every $1 that you get, you would multiply it by that gross profit percentage. So any payments received in a year times that gross profit ratio is going to equal your taxable gain for the year. That's the taxable gain for the year. Then you multiply it by whatever the tax rate is, and that's where then you come up with what the tax is. So here's my cylinder again, graphic to show this. But let's assume that you have a sales price of $400,000, and you paid $300,000, or the basis, the cost is $300,000. So anything that you sell for above that $300,000 represents gain, gross profit. Here, assuming that, well, we sold for $400,000, so 400 minus 300 is 100, and that's the gross profit. So from a percentage standpoint, what the gross profit percentage is, it's simple. It's 25%, right? It's 100 divided by 400, or 100 over 400 equals 25%. Conversely, 75%, because you have to have 100%. So 100% minus 25%, 75%. So 75 cents out of every dollar is going to equal what your cost was. So let's assume that that we sell this cylinder for $400 over 5 years, 5 equal payments of $80,000. 5 times 80 is 400, right? Okay, so I got the number right. Well, here's what the gain is going to look like for each year that you receive. You're going to receive an $80,000 payment. 25% of that is going to equal gross profit, and that's $20,000, right? So let's take a look at the power of this and why is it so important, and why are we doing this? So we have two scenarios here to show it. We're going to assume that we sold this cylinder for cash in 2009, and then the second one is that we sold it in 2009 for a series of equal payments for 5 years. So here's what would happen if we sell it this year, and I'm not doing anything, any more analysis. Joe's going to go into that again. This is just simple to a tax rate of 15% long-term capital gain rate, which $100,000 would be. So we sell for $400,000. We have a $300,000 tax basis. The gross profit is going to be $100,000. It's taxable capital gain, $100,000 at 15% rate. We'd pay $15,000 in tax. So now assume instead of getting that $400,000 all in 2009, we $80,000 a year over the next 5 years. Here's what it's going to look like. The gross profit percentage is 25%, which makes the taxable amount $20,000. In 2009 and 2010, there's a 0% rate up to $65,000, right? This is underneath that amount. So tax is actually 0. And then in 2012, 2013, as it's taxed at, the law sunsets, and it's not really, it goes from 0% back to 10% as it is now. It would be $2,000, $2,000, $2,000. But you can see that you're paying significantly less in tax by spreading it out just over 5 years. Instead of paying $15,000 this year in tax, you're paying $6,000, but $2,000 of it's not even for 3 years, and then $2,000 in 4 years, and another $2,000 in 5 years, and you get interest for return on that extra $15,000, 2009, 2010, $13,000 in 2011. You can see how it just compounds. You're earning interest or return, an investment return, on money that you would have paid to tax, or that you're referring that. It's pretty powerful stuff. One other thing, in installment payments, there has to be an interest component, and the structures or the fallbacks that we do have interest that's payable. And this just graphically shows how it is. But not to get too in-depth, you have an interest component, and it's taxed at ordinary rates. So, yeah, there it is. It's reported ordinary income. There's some rules that you, even if there's not interest designated in the purchase agreement or the sales agreement, that the tax code, you can see it's 7443, requires an interest component. So there's always going to be an interest component. So bottom line on installment sales, the benefits really are that you defer payment of the capital gains taxes. You defer the taxation on this is kind of the wrong way to say it, but on the depreciation, the 25% rate. You create a stream of income, and you can convert unproductive property into an interest for earning investment. And what about the disadvantages? Well, you have a foreclosure risk, because typically in an installment sale, it's the situation that Chris was talking about earlier, where it's a contract for deed. I don't remember all the different ways that it's called a number of different things, but basically it's seller financing. So you have foreclosure risk that the buyer doesn't perform, and you're going to get the property back. And typically, so it's kind of a pain to go through that process. And if you're going to get a property back that somebody hasn't been paying you on, they probably haven't been really taking care of it too well. So you're going to have a diminution in the value of the property too. You have a disadvantage, could be an early payoff. You don't really have control, depends on what it says contractually, but the seller or the buyer of your property may be reselling the property and wants to pay to pay you off early, and that might be a really might not be the right year that you really can take that much income into your tax situation. And Chris is going to talk about an opportunity with that, I kind of call that a busted installment sale. Also, number 3 there, property deterioration. Again, the property could be worth and probably less than what you sold it for if under the foreclosure. And lack of liquidity. You don't really have liquidity in that note. So the structured sale, which I'm going to go into next, can eliminate most of the, if not all of the disadvantages of that installment, of the installment sale. So what is a structured sale? Well, a structured sale allows the seller to receive a fixed income as guaranteed by a Fortune 50 company, and at the same time deferring the capital gain tax. And from a tax viewpoint, a structured sale accomplishes everything it sets out to do. And there are impressive economic results, and even despite the impressive economic results of doing this, there's no tax avoidance, just tax deferral, and that's coupled with the advantages of compounding. It's an obvious choice to consider to create a secure fixed base of tax-deferred income within any sound financial or estate plan. But here are the benefits. It really is. The benefits of a structured sale, taxation to the seller, gains are only taxable as you actually receive them. And here's the important thing. There's no ongoing relationship between the buyer and seller, unlike in a traditional installment sale. So the seller is not going to have to foreclose the property if there's not a payment, which again you don't have to worry about with a structured sale because it's guaranteed by it's actually guaranteed by Allstate. There's also enhanced security because you're not the seller isn't relying upon the solvency, the future financial performance of the buyer managing the property correctly, any of those sort of things. So no ongoing relationship. They know they're going to get paid. It's a pretty neat thing. So how does this work? Well, let's start with a cash sale. We have a seller and a buyer. They're going to sell seller's going to sell a property. The buyer gives the seller cash, and the seller gives the buyer property. So how does that differ from an installment sale? Well, the buyer gives cash, maybe cash, but a promise of future periodic payments, installment payments, right? And the seller gives the property to the buyer. But from a taxation standpoint, the seller only recognizes income or the capital gain on the sale when the year they actually receive the cash. Unlike the cash sale, the first one I went over, where they pay tax in this year. So how about a structured sale? Okay. It is much easier than it looks, Chris just told me. I liked my technological know-how here on the first two easy ones. I could have those things, the lines pop in. On this one I can, but if you look at this is just the installment sale that we just talked about, right? Cash, future promise of future periodic payments from the seller to the buyer, and the buyer gets the property. There's this installment sale agreement. But here's what happens then. So the buyer now owes the seller these payments in the future. But what the buyer does is assigns the liability to make those future payments to an assignment company. They also pay the cash that they would have paid if this was a cash sale to that assignment company. The assignment company, which is an Allstate affiliated company, takes the cash, sends it to Allstate Life. In return, they get an institution, pays the installment payments to the seller when they're due. and the whole thing is guaranteed by the life insurance company. So basically what you've done is changed a cash sale, right, because the seller transfers the property to the buyer's paying cash, but instead of paying the cash to the seller, it goes to the assignment company, so the seller gets installment method treatment. And it really is as simple as that. And here's another benefit to the whole thing is that they're custom tailored payment stream. Payment analysis, and then work with them about creating or designing the payment stream that they want. So the buyer seller, or in the case of a failed exchange, they know what the cash lump sum amount is, and we take that and create in really infinite ways monthly, annually, periodic lump sums, any combination of that to fit the seller or the exchanger's unique financial position, financial tax position. And again, that's one of the things that we work with. There's no restriction on the payment streams. The payments can be structured to keep the taxpayer out of AMT or higher tax bracket. One of the things I was talking about a little while ago with the 0% tax brackets. We've had a few situations where that would actually work with people where they could take a big portion of their gain, in this year and next year, and literally not pay any tax on it because they could put it into 0% rate, which is a very neat thing. And again, the fund loss taxation they earn interest on, which I guess is kind of key to the whole thing. How is it actually done? I'm on the ground. Sales agreement, and we're talking about the base structured sale here. The sales agreement includes language that allows for the structured sale. And then there's a couple of agreements that get signed, and the periodic payment agreements assigned to Allstate, or to the Allstate Internet agreements there. So that's the assignment agreement. And then AIA takes the funds for those future payments, sends it to Allstate, and gets the funding agreement. And then Alllife issues the seller, so your client gets an irrevocable guarantee of the performance of the assignment company. So it's locked up pretty well there. So that's how it works. Now I'm going to go into the legal foundation of how the structured sale works. But really, here's almost for the summary. The structured sale, really, what we're contemplating here is a seller who wants the benefit of treatment without the disadvantages, which I think is a pretty good thing. And the disadvantages, all the things that we already talked about, right? Foreclosure, all that. And the buyer is usually willing to pay off, but again, here the seller doesn't want the immediate tax burden. The thing that I hear once in a while is that, well, if the buyer is willing to pay cash, can they still get installment sale treatment? And the answer is yes, because the transaction is actually the triggering event for tax purposes. It doesn't matter what happens up until that point. What matters is the actual transaction. Actually, for anybody who's interested in tax, a revenue ruling exactly on point about this, where a buyer was willing to pay cash, and the seller wanted installment treatment, and the question was, can they get it? So exactly what we're talking about here. And it's, boy, I'm thinking off the top of my head. It's 73. It's Revenue Ruling 73-396. So if you want to look it up, it's pretty neat actually. So that's how that works. Then there's an assignment, and that's the key to the whole thing. So immediately after the sale is consummated, the buyer, and this is the key, the buyer enters into a transaction assignment company where they assign the liability to make those future payments to the seller. So notice the seller is not involved in the assignment, right? This again is key to what is key to the whole thing. Let's keep that in mind. So there are a few tax doctrines here that are kind of applicable to an analysis of this whole structured sale. And you know, for those of you, if you talk to tax attorneys or CPAs, this is really the kind of the legal/tax foundation of the structured sale. And the four questions are the threshold question is the buyer's assignment of disposition, number one, and then we take a look at these three doctrines because of constructive receipt, cash equivalency, and economic benefit doctrine. And I'm going to go through these next few slides, and I might not, just to give you a heads up, I might not follow them just exactly, but I wanted to include them for reference, I guess is the best way to say it. So I'm going to follow the flow of them, you know, in order, but it might not be exactly what you're seeing on there, but it's for your reference. So again, is the buyer's assignment of disposition, and then these three tax doctrines of constructive receipt, cash equivalency, and economic benefit. And I apologize here. I'm just having the hardest time working this thing. It's just not intuitive to me at all. But talking about a disposition of an installment note or installment obligation, it's almost always problematic, and that's why we're talking about it. Because if an installment obligation is disposed of, then any gain or loss is recognized, and you lose the benefits of the installment method. And a disposition includes not only the actual transfer of installment obligations to other parties, but also deemed dispositions, in which and that's what we're talking about here. So the buyer transfer, that's an actual transfer, and deemed dispositions would be that material alteration and substitution there. But also deemed dispositions where the terms of the installment sale agreement are substantially altered. Now, the existing tax authorities, they make it clear that there's no disposition when a buyer transfers the obligation to make periodic payments to an assignment company in a structured sale, and that's Revenue Ruling 75-457, which was amplified by Revenue Ruling 82-122. And generally, I'd say, you know, these precedents involve sellers. Again, this is key, the key difference between sellers and the buyers, but generally these precedents involve sellers who transfer the installment note. So the question is whether a transfer is a disposition. That, you know, less attention has been paid to the buyer who can transfer the obligation to pay to a third party. Again, the seller in this is not disposing of anything or even altering it, right? And that's what they're talking about here with what I'm talking about with substitution, material alteration with the revenue rulings, and material alteration. Again, there's several leading cases really show that there's no disposition in a structured sale, and that's the Wynn case that was on the preceding page, and this Cunningham case. And in these cases, the courts really examined whether a new note was sufficiently different to cause a disposition. And like their own statement in that Revenue Ruling 75-457, these cases confirm that, and I'm just going to read this here, that the mere substitution and release of the original obligor an installment obligation, and the assumption of the installment obligation by a new obligor without any changes will not in itself constitute a satisfaction or disposition under Section 453D. And then the service, and this isn't on here, but the service even issued a couple more favorable rulings a few years later that there wasn't any disposition. And that was in a technical advice memorandum, which is AM 92-38005. And if anybody wants these sites, they can send me an email. And they also issued an FL service advice in 2001, which is 2001-15073, saying the same thing. So as far as the disposition goes, that kind of summarizes it. And now we're going to take it even a step further, because what we're really talking about here is, Code Section 453, right? And what I have heard from some people is that, well, this is a disposition under 101, and 101, Code Section 101, is the set of the tax code that defines what a gain is, and says that if you have a disposition under 101, that is taxable. So hopefully I'm not talking in a circle here, but because the distinction is a little bit fine, I guess is the best way to say it. But here's an interesting thing in Treasury Decision 8675, which was the Treasury decision that codified the regs under that 101-3, said that you can see there that also is noted in the preamble to the proposed regulations, a modification of a debt instrument that results in exchange under 101 does not determine if there's been an exchange or other disposition of an installment obligation under 453B. So what it's saying there is that you throw out 101, it doesn't matter. So even if it was a disposition under 101, because Code Section 453 controls, it's not a disposition under 453, which is I guess kind of a pretty neat thing. So now let's go into the constructive receipt, the other tax doctrines of constructive receipt, cash equivalent, and economic benefit. All very well aware of constructive receipt, I'm sure, with your business being exchanges. But basically, the constructive receipt doctrine prohibits taxpayers from deliberately turning their backs on income and selecting the year in which they want to receive and report it. So under the regs, Section 1.451(2), income is constructively received if it's credited to the taxpayer's account, set apart, or otherwise made available to the taxpayer, and there's no constructive receipt if the taxpayer's control is subject to substantial limitations or restrictions. So what we have here in the structured sale transaction is, again, the assignment is by the buyer. The seller's not, the seller's still, their deal isn't, for tax purposes, they're still receiving the payments that they bargained for. The party who's changing their what their obligation is the buyer. So the economically, the seller is in the same position before or after, and they're not even a party to that to the assignment transaction. Also, the seller doesn't have a right to the funds that the buyer transferred to the assignment company. What they have a right to, and again, this is a fine distinction, they have a right to receive payments. the same as they had under with the original obligor, with the buyer. So it doesn't matter that that buyer actually took the cash and transferred it to the assignment company. That cash is not being set aside for the seller. It's funding the future payments by the assignment company. And really, I guess the assignment company could theoretically could do whatever, invest it however they want, but it's not the way it works. But it's not set aside in an account that the seller can currently claim if they want to. So it's a very fine but important distinction from a tax standpoint. Well, the cash equivalency doctrine is kind of similar to constructive receipt, but it essentially states that if the promise to pay a benefit to an individual is unconditional and exchangeable for cash, the promise is the same as cash and is going to be currently taxable. Well, here with the structured sale, the documents, the agreement, actually forbid the seller from transferring, assigning, selling, or encumbering their right to receive those future payments. And that language should be somewhat familiar to what you see in your exchange documents. And it actually goes even a step further, that any attempt by a seller to sell, transfer, or assign their rights is void, and that precludes the application of the cash equivalency doctrine. So the seller can't convert this as the annuity. It's actually a funding agreement into cash. Doesn't have any rights to the actual funding agreement, and again, not even a party to the transaction between the buyer and the assignment company. And I know I'm kind of beating this to death, but it really is very important. I mean, it's the tax foundation for why it works. Well, the economic benefit doctrine is triggered when money or property has been transferred to an arrangement like a trust for the sole economic benefit of the taxpayer. We have this, I have the security with a question mark revenue ruling from 1960. Considered situations where there was more than a mere promise to pay and the obligations were secured in some way. These authorities, you can see here, don't contain any suggestion that the structured sale would run afoul of the economic benefit doctrine. And the regs under 453, I'm trying to think of I think it's 450. Okay, I don't know this one off the top of my head, but as you know, you can have a security interest in an installment note, the letter of credit or such, and it doesn't trigger constructive receipt or economic benefit. So the same thing here. And again, there was this case, Sproul versus Commissioner, where a trust was set up for the benefit of an employee, and the court held that the employee received an economic benefit, so the value of the trust was taxable. But here's the difference. The taxpayer's rights in the trust were vested and secured, and the taxpayer was free to assign or alienate the trust proceeds. Here with the structured sale, the seller can't do that. So the economic benefit is not the doctrine isn't a problem. We also had a private letter ruling issued in 2008, September 5th, 2008. I actually had lunch 2 days ago with the person who obtained this private letter ruling. But the importance of this is, and there are a couple of pages here, but I can probably just talk about it. This was the reason that this is important is that this is Allstate. This is the structured sale, It's the Allstate International Assignments is the assignment company for this private letter ruling. But what happened here was they had an individual who filed a claim against their employee for wage and non-wage, some discrimination, hostile employment practice, that sort of thing, and got a settlement. Now, those settlements are taxable, and there's some other kind of bad, not only are they taxable, there's some other kind of bad tax ramifications to it with attorney fees and that sort of thing. But and then you also have alternative minimum tax, all the kind of bad tax things that you have with the sale of a property, where the settlement is somewhat big. So what you had here was the settlement between the employer and the employee, former employee, where that employer is going to pay the former employee a lump sum of cash, and she would have had to take that all into income this year, popped her into alternative minimum tax, all the phase-outs happen, all that sort of thing, and her net would have been very, very small, which is not a good, which is kind of counterintuitive and not really the result that you want, or the whole reason why you pursue the claim anyhow. So they actually set up what's called a non-qualified assignment, where the employer promised to make future periodic payments to the former employee over time, and then assign the liability to make those payments to Allstate International Assignments, then took the cash and paid it to the assignment company. The assignment company funded it with an institutional funding agreement, and now the assignment company is paying those future payments under the settlement agreement to the employee. And so they sought a private letter ruling to see whether or not the IRS agreed that those payments, that this should qualify basically for installment treatment. And you can see they went through the whole constructive receipt, cash equivalency and economic benefit analysis, and their conclusion was that there was not constructive receipt because they agreed on periodic payments. The payor assigned the payments. The payee, the former employee, was getting what she bargained for. Her position has not changed at all. She couldn't assign or any of that language that is in the, let me see it here. Go back to the former employee according to the terms of the settlement, can't assign, pledge, borrow against, any of those sort of things. The only thing that she has a right to is to receive the future payments, not the money or the funding agreement contract. So it's exactly the same thing that we're talking about with the structured sale, except for we're talking about the sale of a property, which is that Code Section 101. This would be under Code Section 61 probably, but everything else is the same, with which is a pretty significant development. So here, how does the structured sale? What are the procedural steps? How does it actually work? When you're working a transaction, is that the buyer and seller agree on terms to a sale, and then they meet with us, and we work with them to determine the amount, timing of payments, all that sort of stuff. And then the seller executes a purchase agreement, delivers title in exchange for the buyer's cash, promise to make future periodic payments, and then the buyer assigns that obligation to make the future payments to the assignment company. The buyer transfers the cash. The assignment company uses the cash to purchase the funding agreement from Allstate Life, and then Allstate Life actually makes the future payments to the seller. The payments come out of here, Vernon Hills, Illinois, not Brook Hollow. Well, Allstate happens to be headquartered in Illinois, so they actually come out of Illinois. And then on top of the whole thing, the life company guarantees the assignment company. So there are layers of protection, and the life companies, I probably should say this right now, with what's been going on in the markets, have really stepped up as being a very safe and secure place for people to have their money. In fact, we saw that with hesitate to say with AIG, the life company that AIG owns is one of the the money there is very safe and secure. So it's actually the money has been pouring into I just read this morning, pouring into these fixed annuities because of the safeness and the soundness, and you can actually get a little bit better return than you can get out in the marketplace. So now let's talk about the fallback. So we have the foundation of capital gains, installment treatment, how the structured sale actually works, the tax and legal foundation for the structured sale. Now what about the fallback? Well, what is it? Well, this is where the exchanger currently has an exchange with you, and they fail to identify a replacement property by day 45, or they don't close on a replacement property before day 180, and has a significant boot issue. But you still have the exchanger still wants to receive some beneficial tax treatment for their transaction. That is, if it fails, you send them back to cash. They're going to pay a bunch of money in tax, and usually what we find is people go into an exchange because they're kind of tax adverse. They don't want to pay tax, and they can't find that replacement property, or they have boot. They're oftentimes very, very willing and want to listen to other options. So prior to, we have this in a different color and in capital letters because it's very, 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 very important that prior to termination of the exchange, whatever the terminating event is, prior to that terminating event, the exchanger gives the QI gives you an irrevocable direction to pay the exchange funds to an assignment company, and then the exchange agreement's amended to provide for an agreed-upon payment stream. So that's where we get involved, as there's an actual addendum amendment to the exchange agreement, and we work with the exchanger to create the payment stream that is put into that agreement that also includes the irrevocable direction to pay. And then at day one, after the failure of the exchange, whether it's day 45, 180, I mean, from an operational standpoint, it's a day or two after, right? Whenever the cash gets sent. But you transfer the funds directly to the assignment company. It doesn't go to Brook Hollow. It goes directly to the assignment company. They use the money to buy an institutional funding agreement from Allstate Life. And then the life company makes the future payments directly to the exchanger. And also the exchanger gets an irrevocable guarantee of performance of the assignment company. And we have exchangers actually getting checks. I know I've gotten calls. So it's kind of a neat thing to see that it's that it's worked, and exchangers are actually getting cash from Allstate. So here's how it works. Here's how the fallback works of what we just talked about. And this should look very similar. This should look very actually familiar to what you've already seen, except for the exchanger was the seller, QI was the buyer. In the other flow chart that we had for structured sales, so the exchanger takes the place of the seller, QI, you take the place of the buyer, And when the exchange fails, the exchange agreement has been amended to specify the payment stream, and you have the irrevocable direction of pay to the exchange funds to the assignment company. You pay the cash to the assignment company instead of back to the exchanger, because if you paid it back to the exchanger, that triggers tax right there, right? This agreement, this arrangement, and the transfer of cash to the assignment company means that the exchanger pays tax right here whenever the year that they receive a payment. And that's the benefit of this whole thing, is that you've taken a bad situation from a tax standpoint for that exchanger who didn't want to pay tax anyhow, but for whatever reason couldn't get their replacement property or all of their property, and they're still getting tax relief. And usually, and Joe will go through this analysis, but so I'm going to go through the legal foundation. Chris is kind of groaning when I said that, because he loves, Chris, when you see him out in your offices, just ask him how much he loves the tax code, and especially to read it. Anyhow, I'm tweaking him a little bit. So the legal foundation for the fallback is to remember everything that we talked about with the tax foundation, the legal foundation of the structured sale, of why that works. So now we're going to layer on a couple of other things. Basically, and the question that everybody always asks, how can we have the QI make a promise to pay those funds and the taxpayer exchanger get installment treatment? We'll go through 94, and you're going to see most of this is not going to be any sort of a surprise. But the search to the reg under K1J2 regs that coordinate safe harbor provisions of 1031, okay, K1G, for deferred exchanges with installment sales. That's 53 in the rules under 15A, 453, you see them right there. But the regs, the J regs, adopted with few changes that were proposed by the IRS in November of 92. So the proposed regs for 92, they were adopted in 94, and that's Treasury Decision 8535. And there was and also this notice of proposed rulemaking was the proposed regs in 92, so it's K 732. So those are the sites to what we're going to talk about here. But under 1031, under these J regs, again, this isn't going to be any sort of surprise to you. The cash that's held by the QI, or I'm sorry, if the cash is held by a QI, is this the safe harbor? Then the QI is not the agent of the taxpayer in determining whether the taxpayer received a payment for purposes of Section 403. So to take it just a little bit further, if you were an agent for somebody, you could enter into, well, let me back off a little bit. Just go down this road because I'll get to that in a second. But the QI is not considered the agent of the taxpayer, determining what the taxpayers received a payment for purposes of Section 53. And remember, 53 is the installment sale rules. The installment method, one or more payments received in a year other than the current tax year, that you pay taxes in the year in the proportion to your gain in the year that it's actually received. So anyhow, the QI is not the agent of the taxpayers, is the safe harbor, until the earlier of the time the taxpayer has immediate ability or unrestricted right to receive or otherwise obtain the benefits of those payments, constructive receipt, or the end of the exchange period, the end of the contract period. It also says that a person who otherwise satisfies the definition of a QI is treated as a QI even though the QI ultimately fails to acquire identified replacement property and transfer it back to the taxpayer or to the to the QI. That's kind of another key concept. So you're treated as a QI and not the agent for the whole period, even if the replacement property identified isn't acquired. So the effect of this allows the tax-paid exchanger to report as an installment obligation the obligation of the QI to transfer money to the taxpayer in a deferred exchange under the installment method of 453, right? And there are a couple of examples there. So it's a multi-year exchange, and also the buyer note rule. But again, the safe harbor ceased to apply at the earlier of the immediate ability, the constructive receipt rules into the exchange period. A couple of important points here. The rules don't apply if the relinquished property is not held for productive use in a trade or business or for investment, obviously, or if the property is ineligible due to Section 1031A2. So we can't use a non-eligible property, put it into an exchange, and then do a fallback. Doesn't work. And then the rules, and we've gotten a little pushback from people in the past on this, that the rules don't apply unless the taxpayer has a bona fide intent to enter into an exchange at the beginning of the exchange period. But what we're talking about here with the fallback is that they actually have a bona fide intent to enter into the exchange. This only gets triggered if the exchange fails because they're not able to identify a property or to close on that property identified. So here's kind of the meat of it, and then it kind of goes to the buyer note rule. But the J-regs to provide a special rule in the case of a taxpayer who receives an installment note directly from the person to whom a QI transfers the relinquished property. And kind of what we're going to get to here is whether or not the QI in the under 1031 for the deferred exchange rules is the transferee of the exchanger, because under what Code Section 453 says to qualify for installment sale treatment is that you dispose of a property, right? So who you dispose of the property to is your transferee, and that disposition is what triggers being able to recognize or get the installment method treatment. And then if you get paid for it over multiple tax years, you pay the tax in the year that you actually get the cash. That's kind of the whole basis of this. So whose is the QI, the transferee of the exchanger? Well, this buyer note rule provides that for purposes of 453, right? And 453 are the installment sale rules, and that's what we're trying to qualify under here. And the regs under that, that the receipt by the taxpayer of an evidence of indebtedness of the QI's transferee is treated as the receipt of an evidence of indebtedness of the person acquiring the relinquished property from the taxpayer, which just means that the reason it got put in there was the situation where you had a buyer note, right? The ultimate buyer of the relinquished property gives a note. The note goes to the QI. The QI then assigns it to the exchanger. Wouldn't qualify under 453 without this reg, because the note's not coming from the transferee, the person or the entity to whom the property was disposed of. So that would trigger a disposition. So, again, the question is the QI the transferee under 453? Well, the preambles to the proposed and final regulations, we make it clear that for purposes of 453, the QI is the transferee of the relinquished property, and which makes this work. So the notice of proposed rulemaking and you can see the site there. Says the proposed regulations also provide a special rule for deferred exchange in which the taxpayer receives the installment note of the person to whom a qualified intermediary transfers the relinquished property. Because the qualified intermediary's transferee is not the person who acquired the property from the taxpayer, the qualified intermediary is treated as that person. The taxpayer's receipt of the transferee's evidence of indebtedness may be considered a payment to the taxpayer under 15A 453(1)(b)(3)(I), right? So there's the preamble saying that the QI is the transferee. And then in the actual Treasurer decision, which adopted the regs, right, says the regs provide a special rule for deferred exchanges involving qualified intermediaries. Under this rule, a taxpayer in receipt of an evidence of indebtedness of the qualified intermediaries transferee is treated as receiving an evidence of indebtedness of the transferee of the relinquished property, even though these regulations generally treat the qualified intermediary as having acquired and transferred the relinquished property for other purposes. Therefore, for purposes of 453 and the regs, the receipt by the type blah, blah, blah. So that's pretty much established as that. And then, again, we talk a little bit more about this PLR from September, where the intermediary is going to assign its obligation to make the periodic payments and fund its obligation. But anyhow, I just give you a little more clarification of the constructive receipt, how that is not constructive receipt to the exchanger because the exchanger is not involved in the assignment. So let me look at this last one here. Yeah, and also the constructive receipt's not going to apply because the taxpayer doesn't have a right to receive the payments before the time that's actually fixed by the exchange agreement with the fallback amendment. It's kind of like that revenue ruling 73-396 that I talked about, is that what controls and what fixes the tax treatment is the contract between that establishes the economic performance of the transaction, I guess is the best way to say it. Doesn't matter what leads up to it, what either party is willing to do. What matters is the actual form and substance of the transaction. And here, it's actually fixed by the exchange agreement, and it's not triggered until the actual failure of the exchange, or the failure of the exchange. And the QI is who the property was disposed of to, the transferee. So how does it work? Here are the procedural steps of the fallback, but and you'll see this is very similar to the structured sale. So we built upon, it's kind of built upon that. But the qualified intermediary identifies the possible fallback client. You confer with Chris. He's our point person. He's really good at this. You go through all of the qualifications, talking about it. He can help you with how to talk to the client, questions to ask. He would even get on the phone with you if you want to talk with your client. And then we go through the questionnaire, our analysis that Joe's going to go into. And I have to say, it is really a thought-provoking, in-depth analysis that gives the exchanger, a real base to make an informed, intelligent decision on. It's not kind of like, well, I think I can save some money. I mean, it's like, this is what you're going to pay versus what you're not going to pay, and based upon what you've given us, and what you would have to get in an outside investment to match what we're doing. And this is fixed, guaranteed, all that sort of stuff. They'll go through all of that. But we present that to the client and work with them and talk it through to them, and go through all the paperwork. And those of you that have actually done these, you know that the paperwork is not involved at all, and Matt handles most of it. He does all. He do most of the paperwork. Matt, our operations person, does a great job of dotting the I's, crossing the T's, make sure we have everything. He follows up on with the with all the stuff, and gives you everything that you need. And then what happens is we track it through the assignment company, through the life company, follow up and make sure that your clients actually receive their checks, make sure they receive their first checks. We follow up with the assignment company right before that first check is going to go out. Make sure that they're sending it. That they're always going to send it, but it's just good to always follow up and pre-follow up, and then they get a touch. The client gets a touch immediately afterwards to make sure that they got that check. You know, we get questions with it being tax time now. We're getting some questions. Follow up from CPAs when they're filling out their tax returns for this year or for last year, and the tax treatment and all that sort of stuff. So we provide a lot of back-end support too. And now I'm trying to. Do I have to push it again?
Yeah.
Yeah, we've pretty much covered this, but you have it for your. And now we're going to go into the actual case analysis with Joe. And I'm sorry, I'm going to hand it off over to Chris.
Yeah. Thank you, Brian. Now, I hope we had mentioned that this was an advanced class. And with that said, thank you, Brian. That was excellent. I'm sure some of you folks may be feeling a little overwhelmed, which is fine. But please, and I say this with confidence because you should feel this with confidence, do not be intimidated. What you just heard is why the fallback works. And a number of you on the phone probably run into some mainly attorneys that are like, I've never heard of this or this doesn't work. The bottom line is you just heard that why it does work. And this conversation, I've heard Brian talk with your client's attorneys on this, and boy, does it turn, yes, and I said this confidently because you should be out there confident with it, it does turn them so they understand. So Brian, thank you. That was excellent. Moving on to our next portion of the entertainment for this afternoon. We're in our fourth quarter here. Thank you, Brian. That was great. Before I turn it over to Joe, I am going to get out of this. He's going to go through actually the client deliverable. And every time we're talking with the direct client, this is something they're going to see. So where does that start? That starts, of course, after we've had the dialogue with the client. And I'm going to get out of this. And a number of you have seen this. And this is available to all of you. And a lot of you already keep this in your files. There'll be no making fun of my desktop. This is where it all begins. And this was designed by Brian and Joe and some of our outside counsel on what to gather and all the information we need to provide a 360-degree consult to your clients. And again, a number of you have seen this. But this is sent to gather the information, and typically we're talking at this point with the client and their tax advisor and CPA on the phone to get this information, specifically the transaction details right here, to maximize the consequence or minimize the consequence that they're looking to get help with, and of course then encourage the most amount of growth on the interest component. So with that said, I'm going to get out of this, and Joe, I'm going to go ahead and pull up the client deliverable PowerPoint, and that's not it. And feel free to take it away.
Here we go. Here we go.
All right. Welcome.
I'm here. Welcome. I'll just verbally take a step back to the questionnaire. We don't have to necessarily take a look at it, but if those of you out there who had a chance to maybe take a peek, you'll notice that we're asking for things like the taxpayer's AGI, number of children, filing status, total net worth, what amount of home equity is included in that, planned retirement date. Some of these questions can be quite personal in nature. And although it's only a 2-page document, there's a lot of sensitive information, and I think there's probably just a natural reluctance to just hand that information over. But when you take a look at what we deliver and take a look at how we use it, hopefully that will get you comfortable and allow you to get your clients comfortable that we're really putting it to good use to try to determine I guess the best way to help them. So if we go back to the spreadsheet.
Sure.
What we do is we take that information and essentially use it to complete the blue shaded cells in this spreadsheet. This spreadsheet is approximately 480 columns out to your right. You can see the closing, and you start seeing 1, 2, 3, 4, but it goes out 480 columns out there. And what that does is that's every month of activity in the taxpayer's financial scenario as it relates to this transaction. So what we do is we will fill in the blue shaded cells with details of the transaction. You can see right below the large 8.73 that's highlighted in yellow. You'll see what the taxpayer's return of basis is, capital gain, Section 1250 gain, and possibly ordinary income. In the example that you have before you, we have a property that was purchased for $2 million, depreciated down to $200,000. So in other words, $1.8 million of depreciation was taken, and then the property sold for $3 million. So the taxpayer has $2.8 million of total gain, which is $3 million minus the $200,000. Of that $2.8 million in gain, $1 million is treated as capital gain, which is long-term capital gain, and $1.8 million is treated as 1250 gain, which is taxed at 25%. Why don't we go up to the top a little more, Chris?
Sure.
And we'll take a look then. So those are the details that relate to the taxpayer's transaction. And that's probably kind of what you guys are obviously very involved in that. Then we get into the federal ordinary income tax rate, federal capital gains tax rates, federal effective rate add-on, which we'll talk a little bit more in depth about, federal Section 1250 tax rate, state capital gains tax rate, state ordinary income tax rate. So all these tax rates. Well, every taxpayer has, not every taxpayer has a different tax rate, but there has to be some judgment exercise to determine just what their implication is going to be. So we will take a look at what their adjusted gross income is. What category do they fall into? Are they, if we were to just to draw some broad categories, you might say, well, there are people that are just, they make all kinds of money all the time. They're going to be in a 35% tax bracket. AMT is probably not going to bother them. Then you have other people who, they're good, hardworking Americans that just happen to have some money invested in some real estate, but their income is I'd say relatively modest, just because it's under the thresholds of kind of getting beaten over the head with the tax code, and maybe they make $150,000 to $200,000. And all of a sudden they get a big gain into their tax return, and the tax code can be quite punishing to people that the government deems successful. So what we try to do is calculate, figure out what rates make sense here, what rates are applicable. All right, and they're pretty straightforward. Figuring out a federal ordinary income tax rate, it can be relatively straightforward. Obviously, the Section 1250 rate is defined. State rates are pretty easy to access, but we get this federal effective rate add-on. And, you've heard Brian talk about it. Once your income goes up, you're quite a few traps set that effectively raise your tax. And we've seen this number obviously be anywhere from 0 to as high as 8%. It can be quite punitive at times. In this case, this taxpayer's case, was 3%. You basically lost the effect of all kinds of deductions and subjected himself to AMT. And let me just talk real briefly why this works. Most of the penalties or punitive portions of tax code are for individuals are triggered by the taxpayer's adjusted gross income. And while tax rates are applied to taxable income, the punitive rules apply or are determined based on adjusted gross income. So if you have a large capital gain, that is included in your adjusted gross income. And so then it wipes out all kinds of deductions and benefits, and also subjects you to things like alternative minimum tax. You've heard about it in the papers. Everyone hears about it. Nobody really knows how it works among taxpayers. And so we're trying to educate people as we go along. Now, let's just say in this case, this taxpayer has this $2.8 million of gain in 1 year. Well, obviously, they're going to be subject to this AMT. They're going to be subject to some different punitive effects. But if we can spread that gain out over a number of years, we can eliminate that federal effective rate add-on. So in this case, the taxpayer has $2.8 million of income, of gain. He says, look, first of all, he says, I got $2.8 million of income. I'm just going to pay my 15% and be done. They're usually kind of surprised to hear about the 25%. And then they're kind of surprised to hear about the 3% effective rate add-on. And then they're really just surprised to hear that they're not going to get to deduct any of their state taxes because you can't do that if you're an AMT. And all of a sudden, when we really run the numbers, the taxpayer is going to pay $866,000 in taxes. You see that number in red, slightly down to the right. Yeah, Chris has the cursor there. And then, take that off the $3 million, the taxpayer is left with $2,134,000. Still a nice chunk of change. It's $134,000 more than he paid for it, which is, can not feel so good. In our solution, or in our scenario, if we go down, at closing, instead of taking any of that cash, that $3 million rolls into a structured sale. And then that $3 million comes out over time. So at closing on day one, the taxpayer now has tax savings of $866,000, which, not ironically, match exactly the tax that he would have paid on closing if he took the cash. Now, here's one of the nice bold yellow metrics we use. We call it percent of investable proceeds. The tax savings that the taxpayer is going to have as a percentage of the cash, the after-tax cash, which is, in our example is $2,134,000, that percentage is 40.58%. Anything in double-digit percentages means we're going to have a decent benefit. Another way to think about it is, instead of having $2 million working for you, you have $2.8 million. Instead of $2.134 working for you, you got $3 million working for you. So you've got an additional $866,000 working for you. If you could have 40% more cash working for you, obviously that's a very good thing. Now let's take a look at the impact. If we go back up to the top portion of our spreadsheet of our analysis, we will find, we'll talk with Allstate and take a look at what the institutional funding agreement earnings rate is. It's kind of a mouthful, but basically we're just talking about an interest rate. And that is, in this particular case, 5.29%. You see that number in yellow. All right? And that's what Allstate has agreed to pay based on the timing and payments that the taxpayer selects up front. All right? That 5.29%. When we take a look at and we take a look every month at the cash a taxpayer is going to get, how it's going to be taxed, it's going to come out as interest. Is it going to come out as 1250 gain? Is it going to come out as a return of basis? Is it going to come out as capital gain? What is the state tax? What's the state tax impact on his federal tax? All those things are calculated. And when you take a look at the cash that he has left, what the taxpayer has left, okay, and then try to calculate, then take that amount and come up with an equivalent rate of return that the taxpayer would need to earn on his, if he just took the cash and paid the tax, what would he have to earn on that $2,134,000 to match what he gets in a structured sale? And that's our magic number, 8.73%. Okay? Now just think about this a little bit. Obviously, we've done all kinds of analysis to come up with this number, but just think about this intuitively. The difference between 8.73 and 5.29, about 3.5%. 3.5% is a percent of 5.29, probably about 40%, right? Maybe, something like that. So what we come up with of the total is about 40%. So you can see where that the percent of investable proceeds really is like an add-on, okay, to any interest rate you could get. And so when you've got 40% more money working for you, you're going to have 40% more rate of return. You're going to defer those taxes. Then we talk about, okay, and we've done this analysis, and you can see equivalent rate of return. We don't even really quantify some more of the, let's just say, qualitative or anecdotal benefits that are there potentially in that, let's say that you're in retirement, or the taxpayer enters retirement midway through beginning to receive the payments, and he's in a lower tax bracket. That is a benefit. Let's say that the taxpayer retires to a no income tax state. That's another potential tax savings. And one other thing to kind of think of is, let's say that the taxpayer has some losses built up in other properties. Unfortunately, he hasn't been lucky in everything, and he does take those losses later on. Instead of having, if you're familiar with the way capital gains work, you can only take them to the you can only take losses to the extent you have gains. Well, now this taxpayer has gains that he's taking every year that can at least help, offset those losses. So there are a lot of other ways that this kind of keeps the taxpayers' options, or I don't want to say options because they don't necessarily, it's not really the right word, but his situation is a little bit more flexible or a little bit more dynamic in ways that can benefit him. And we'll take the facts that come in the questionnaire, we'll prepare this analysis, we'll put it into a nice proposal, and then talk to the taxpayer and try to just explain, here's what's going on, here's what we think this solution can do for you. And, most of these guys get into a 1031 because they don't want to pay taxes. They don't like it. They want to keep the money they think they've earned. And then, God love them, it's not all about luck. Maybe they did something right and they want to keep it. So that's what we're trying to do for them. Do we have any other slides, Chris, talking about the profit strip or about?
Yeah, Joe, that's coming up. We've got another about 14 minutes here.
Okay. Do we have? Okay. Do you want me to just sit tight and pass it back to you, or?
Yeah. Why don't we let's continue to go through this, and we'll bring that back up where we hit it here, which is coming up. Yes, Joe. So thanks. That was great, and that was a real client situation where Joe and I were on the phone with the client and the client's CPA confirming these numbers, and it was really an attractive situation, as Joe had mentioned, and really kudos to Joe for coming up with these spreadsheets and calculations. But and this is pretty much verbatim on what the client had said. It was like, 8.73 guaranteed under this regulated product. He goes, that's a lot better than the minus 40 I've had in the last 6 months. And regardless, this is at least a good portion of, we used to call this the conservative portion of a person's portfolio, but all of a sudden, 8.73 is not that bad. So, Joe, thank you very much. Okay, a summary here, and a lot of you, as mentioned, know this, but again, opportunity finds here. Of course, when the exchanger is failing to either find something that's appropriate for them, or failing to close on all their IDs, or all the IDs had blown up, we one second here, we've got a question. Good timely question. Thank you. The question is does this require an ID? And it's a positive answer. The answer is no. This does not require an ID. So some of you folks actually here call this the quote-unquote fourth ID. But no, it does not require one. So this is there for you and your client in quote-unquote their back pocket when needed. So again, failure in the 45th or 180, or where there's equity boot, so anywhere between the 45 and 180, and they close on something, and there's no IDs left, it would be at that point in time. In a failed reverse exchange, this has come up a little bit, but where needed and where appropriate, this can be used for a failed reverse. And as we mentioned, non-exchangeable assets, personal residence, vacation home, goodwill, and something that isn't here, and a number of you have already referred clients to us, is private stock, private offerings. So maybe a good way to look at this is, with some exceptions here, but overall, any asset with a capital gain that isn't a publicly traded stock, we may be able to help those people out. So that's maybe a good way to look at it, so these non-exchangeable assets. Going forward, a short-term deferral, you know, we've seen where some clients, they're not necessarily interested so much in earning a significant amount of interest. There's more benefit in just being able to defer this out over time. We've seen deferrals as short as 3 years, and depending where the rates are, sometimes 2 to 3 years, where a client will be whole on this deferral, meaning there won't be any money lost on the interest component, and they'll get full leverage of the deferral in time. So again, there's really limitless ways in where we can help, as long as we have a chance to talk with the client and find out what their or the company's personal goals are. And number 5, of course, the exchanger, for whatever reason, if they have absolutely no interest in being in real estate for whatever reason, either before the exchange or while they're in the exchange, but they still need or are looking for some deferral relief, we are in an excellent situation. And a number of you have been sending us, and this is where it's been probably the most popular, is with farmers or with landowners, where these folks are looking to turn that into cash flow for whatever reason, and maybe they're not comfortable with, of course, the bricks and mortar on top of the land. This is a great way for them to have an exit strategy and turn their hard work, is what it comes down to, into a deferred, growing cash flow for them, their family, their company, whatever the case might be. And yeah, Joe, here's where we're talking about this. These are really 3 ideas that have come out. Really, the 3 of them have come out from our conversations with all of you, and one of these has actually already turned into business. And I'll start it off, and then I'll turn it over to you, Joe. But this last point, what I've called the busted installment sale, and this is a situation where the client, the buyer, had one more note payment, and was a little over $500,000 left to the seller. Well, the buyer got an offer they couldn't refuse, and so the buyer now turned into the seller. And there's nothing stopping a client from doing that, or a taxpayer from doing that, when they're still in a note. So this client was brought to us by one of your colleagues, and the client was like, you know what, the original seller is selling their property. We don't want to take constructive receipt of this money. What can we do? Well, the nice thing here is we could continue that note. They rolled it all over into a structured sale, and they were able to reset their cash flow. So what this client did is they took that $500,000, starting payments in another 3 years when they're starting retirement, so they'll be in a lower tax bracket, and then they're going to stretch that out over 12 years. So they're able to reset that cash flow and push that into years where they're not going to be paying as much on the interest component. So it was really a win-win for really for all of us here on the phone and the clients, both the buyer and the seller. So a good strategy and a good situation there. And Joe, I'm going to turn it over to you for 2 things here that I think a lot of you are going to find extremely intriguing. Joe?
Great. Thanks, Chris. Yeah, the matching the debt, strip out the gain. Let's just talk quickly about matching the debt first. I think it's a little bit easier to comprehend. Is in this case, you know, let's say the property is subject to debt. You know, the debt's paid off at closing of the relinquished property, and you know, now there's a lot less proceeds relative to the gross sales price to structure. And in that case, the proceeds are treated as, the debt payment at closing is treated as proceeds for installment sale purposes. So if we conceptually just go back to the example that we showed in the spreadsheet where the property was sold for $3 million, let's just assume that $1.5 million, there was a $1.5 million mortgage on that property, and that was satisfied at closing, and there's only $1.5 million left to structure. The $1.5 million of debt that was satisfied at closing is treated as proceeds for installment sale purposes, and so there still is quite a significant tax consequence at closing. One strategy is to put cash back into the exchange in an amount, any amount up to the total amount of debt, so that the full $3 million can be structured. And you know, nowadays a lot of people are really sort of clamoring for cash, but to the taxpayers who really want to take full advantage, you know, we showed in the example there, I think it was $800,000 that was being paid on $3 million. So, you know, we're talking about an effective tax rate of probably over 30%. You know, in that case, you know, if he puts $1.5 million back, he's got that much more money working for him. So, you know, it's not it's a very, very good way to get a good return on your money, and certainly something to think about. In the second bullet point item there, strip out the gain, this is an idea that we're really excited about because it offers the ultimate tax savings and flexibility to the client. Yeah, you know, a client, let's take the $3 million example again, conceptually, and just say that there's $1 million of basis, and the taxpayer doesn't necessarily want to tie up, you know, $3 million for the next 20 years. And if he puts it in the structure and takes it out in a year or two, he's going to have to pay the tax on that. You know, what he would prefer to do, you know, I guess an option that he has that we've come up with is that he can find replacement property for only the amount of his basis. So let's just say he takes $1 million of his exchange proceeds and reinvests it in $1 million of property and structures $2 million. He now has the $2 million that's structured is pure gain, okay, and therefore the tax and with the gain follows the tax, and so the tax consequence will not occur until that money is taken out of the structure. And he's got a property that he owns that's worth $1 million. And whenever that taxpayer decides to sell that property, you know, after presumably an appropriate amount of time, which could be a year, 2 years, you know, something along those lines, when that property is sold, let's say that there's no gain, that the property is sold for $1 million, or maybe it's sold for $1.05 million, there's a modest gain on it. There's no tax. The taxpayer now has all that cash in his pocket. So theoretically, within a year or two of the sale of his relinquished property, he can have cash tax-free in his pocket equal to the basis, okay, and then have the gain stripped out of the transaction and structured over time, and then obviously deferring the tax and achieving an even higher equivalent rate of return. So we're pretty excited about that idea, and if that's something that, you know, because it involves replacement property in an amount equal to the basis, we really need to get involved prior to that 45th day, you know, to really do a good job advising the taxpayer on how to employ the strategy.
Yeah, Joe, and I think that's an excellent point. I think a lot of things here that we keep pointing to and we keep encouraging all of you to do is getting us involved earlier. The bottom line is when you're talking with clients and they're on the fence, you really have some some quantifiable marketing assets to tell them, look, let's get you into an exchange at least for 45 days, and you'll have time here to take a look at some of your different options. Worst case scenario, we'll send you your check at the 45th day. Best case scenario, you've maybe found some strategies here that are going to set you and your family up fairly nicely. So there's a lot of opportunity here for at least opening up a file. And Joe, I appreciate your help on this one. But these are ideas that, again, are letting all of you open up more business and potentially helping the client out, which is, of course, the primary goal for all of us. Okay, with that said, we've got 2 minutes here, and we appreciate everyone's attention here. A couple of quick notes. I do want to thank Russ and Suzanne for helping coordinate this webinar. Everyone that's eligible is going to get 2 hours of CES, and we will be bringing out more CES classes as we continue on to keep educating really all of us on what we can keep doing here with our partnership. In the next 2 to 3 weeks, we just heard back from NASBA, finally, that our 1, 2, and 3 hour courses, similar to the ones all of you have been seeing, are going to be eligible for CPE. So those of you that have really been utilizing me in the field or through webinars, we're actually going to be approved for webinars as well for an hour, 2 or 3 hours for going after your CPAs, and we'll of course keep you posted on that. A number of you have been helping us get approved in your state for CLE. So those of you where that's an option, give us a call. Let us know what we can do to help. But let's get this approved for CLE. So when you or I'm out in the field with you, we can be talking with the attorneys. And really, last point, please do not hesitate at all. For a number of you, I talk with you a few times a week. A number of you, we maybe haven't talked as much. If you have any questions on even where to get started, as simple as that, give me a call. I'm happy to walk through what's been working with your colleagues, where we can start. Obvious answer is working with your title resources and starting there. But we've had a number of successes here where if you're not utilizing us, please do. There's a direct correlation between when I've spent time with you in the field and working with your clients to really turning this into success. So. With that said, we are 4 o'clock, at least here in the Windy City time. And again, we appreciate all your time. Joe and Brian, thank you for your help on this, and we look forward to hearing from all of you real soon. Take care. All the best.